And welcome to kind of an emergency debate on multifamily naked truth. We had a surprising and a not so surprising announcement yesterday. The Bank of Canada, they increased their overnight rate a quarter of a point to 4.75%, which has now brought the prime lending rate up to close to 7%. I think it's 6.9 or something like that. Now, this has not come to a shock to Mike and myself, but it has come to a shock to a lot of people. Now, just want to introduce my co-host, Dr. Michael Bugg, my business partner, Multifamily. Mike, glad you could come out today. What do you think of the rate hike?
Well, as you said, we weren't shocked. I'm laughing because you said we're in for a debate, and I was like, I don't know if we're going to be debating. We kind of agreed. But yeah, we're buying a personal house, Rosalie and I, and we finally found the location we wanted. And I was texting you before this, and I was like, we want it all buttoned up here before Wednesday because it's coming. So it wasn't really that shocking.
No, and it's interesting. So one of the first things that I discovered is when I was going through my Facebook feeds yesterday and Twitter, people are just going bananas over this, right? The pundits. And I don't want to pick on real estate agents or mortgage brokers, but a lot of them were, in that category. And I remember in March, the headline was very distinct. A lot of these same people were coming out on Facebook, coming out on email and social media, declaring an end to interest rate hikes. It's like, okay, the bank is done. Things are going down, inflation is going down, everything is good. And this is also the bottom of the housing market, coincidentally. So we've seen a price drop from February of 22 to basically March of 23. So it was a 12-month decline in a lot of areas, especially Ontario. So a lot of these same people were declaring a bottom to the housing market. Okay, now we need to buy in quickly. We need to buy in quickly. And with that announcement and that message seemed to resonate because we saw a very strong rebound in the housing market, 17% year to date. And I think this is one of the indicators of the Bank of Canada saying, okay, we need to take this seriously and act now.
Mm-hmm. Yeah, I mean, we saw inflation data turned and ticked up slightly. The other thing that's interesting to me is we haven't even factored in like oil, the price of oil, which is, fairly substantial as it affects the price of a lot of things, has actually been coming down. And so I'm curious, if we see oil start to trend back up, that's going to put even more inflation pressure, as that starts to move through the system. So yeah, I'm not shocked. The rates being higher for longer is kind of how we've been operating and underwriting, all year.
Yeah. And so I think for multifamily owners, obviously that's the focus of our YouTube channel here and our messaging. The end result of this is going to be higher rents, especially in the markets that we're invested in. I mean, it's inevitable at this point. So we're going to talk about who's affected, how they're affected, and why I think multifamily owners are going to benefit the most from this. Although there's a lot of political, things going on right now in this country. So that also needs to be addressed. So, we talked about the headline yesterday. Obviously, the politicians are out, the conservatives are out giving it to, the liberals. Chrystia Freeland comes out there basically throwing her hands up in the air and blaming Putin and COVID for inflation. So, Canadians are obviously concerned about this. I don't know if they're getting a lot of reassurance from politicians.
No, I mean, that's the way the game's going to be played is we got to find where we passing the buck, where we passing the blame to. But I mean, inflation has to be, one of their top priorities because that starts running away on us, and that can get pretty out of hand pretty fast.
Yeah, I think on a political scope, I think it's all about optics. And when I say optics, I think for the government, the position that they're in right now, I mean, no government wants to go into an election with a failing economy. So right now, I think it's a matter of what's worse of two headlines. So the headlines you saw yesterday were, the guy in suburbia in Toronto that's paid 1.2 million for a house and on a variable rate mortgage. Now he's seen his payments go up, $1,500-$1,800. And now he's worried he's going to lose his house. That's dominating the news cycles. The second half of that is the single mom renter who's at the food bank who can't afford, food because of rent hikes and, increases at the grocery store. And I think that is the worst of the two headlines, which is why you hinted with inflation. I think that's going to be the target for the government going forward, regardless of collapsing the housing market or an adjustment to the housing market. I think they're going to be hell bent to get to that target 2% in the next 12 months.
Yeah. I found it interesting when we were on the decline with inflation. The best way I've heard it described is, imagine if I was trying to lose weight, right? And I was reporting to you, Corey, monthly. And I was like, came back and in the peak of it, I'm like, oh, I gained 9 pounds last month. And then I come back to you, I'm like, oh, I gained 8 pounds last month. Then I come to you all excited. It's like, hey, I only gained 4 pounds last month, right? And it's like, you're still gaining weight, right? Like, and that's where, when I saw like everyone was just rejoicing as we were coming down, it's like, we're still high, right? And the government, even if we do, whenever we do hit this magical 2%, we still have to remember that still means we're constantly inflating, right? Like that is what they're
yeah,
aiming.
and there's this belief that rates are going to drop again. Like you say, it's like we're not losing weight. There's not going to be rate drops anytime soon. A lot of people that are buying houses now are getting in. They're getting these messages that, okay, this is only temporary. When I go to renew my mortgage or this and that, you know, rates are coming down. They have to go back to normal levels of 2%. Well, let's go back. I got news for you, folks. 2% is not normal. 5, 6, 7, 8% is normal. This is the new reality, and this was not changing anytime soon. So we were discussing our first few houses. So optics aside for the government, now we're going to go to the past. Now, my first mortgage was 8%. I did a house hack in Saskatoon in the year 2000. I was 27 years old. At that time, very few people my age owned a house, you know, maybe 10%. I had a very high paying job then. I was making about 70,000 a year. And it was tough to qualify even for 100,000 mortgage back then. But I did it. I paid 8%. And I remember in 2001, one of my buddies got a rate of 5.5. And he was just jumping for joy. He was doing cartwheels. And I couldn't believe he could get such a rate of 5.5. It was staggering. Now, this was, of course, shortly after 9/11. And we've basically been in a low interest rate holding pattern, you know, with the financial crisis, with COVID, everything else for 20 years. We've been in this artificially low interest rate environment. And I think now, you know, the bill is just coming in now to pay for that 20 years of exuberance.
Yeah. I haven't had as much experience as you. I think my first one was 2.99, if I think. So my entire investing career and ownership career has been in these low rate environments. Where we maybe differ a little bit is I don't see how long term, like I feel like at some point something's going to break and they're going to have to hit the relief valve and lower rates again. Like it just seems like, you know, that the low rates are needed to like sustain whatever we have going on here. I do think, as you said, in the short term, to bring inflation down, rates are staying in this range and slightly ticking up for a while longer. But I think if we start going out like several years, at some point, I think we'll have a pullback and they'll draw down, you know, but to what level, I have no idea, right? Like no one knows.
I mean, 5% is a nice balance because it enables seniors and people on fixed income to get yield, right? When the rates collapsed, they couldn't get yield, right? I mean, the bank was paying 0.1%. So if you were a senior, you were losing your money to inflation, or you were forced to invest in riskier assets like stocks or real estate, which obviously isn't risky for us. But if you're on a fixed income, that can be a difficult decision to make. So that's the benefit of this right now. I mean, I have a lot of my stuff in fixed rate GICs that are tied to prime, right? So that's a safe place to put your money right now. But yeah, it's a range of debate on what's normal. I partially agree with you. I think if there's a recession going to happen, or you know, if there's going to be a massive stock market correction or housing correction or a big recession, yes, certainly rates will come down. But the bond yields are not showing that right now. I mean, we had a massive surge in the bond yesterday. You know, we're approaching 3.9, which is the highest it's been, you know, since 2006, 2005, right? That is not a sign that they're worried about a recession anytime soon. The bond market is signaling that the economy is very much hot and we're going to see more of this, right? But then again, things can change very quickly in this marketplace.
Yeah. I guess I'll throw some tangents and curveballs in here. I mean, it's probably worth discussing, you know, what is inflation, right? And when I look at, you know, what is a house in its like really simplistic terms, it's a place to live. And when we look at over, you know, 20 or 30 years, has the value of that house gone up? And okay, we can argue, yeah, they're more energy efficient and you have more luxuries in them, but if we compare it apple to apple, like a similar house 30 years ago to a similar house now, the fundamental value hasn't changed a lot. It is still a place where you can live and have shelter and stay warm. So then, well, what has changed? And it's not so much that the value of the house has gone up. It's that the value of the money being used to purchase the house has gone down. Right?
It's the expansion of the money supply, correct?
So yes, so you need considerably more money to purchase that same amount of house value, right? So when people say, oh, the value of my house went up, it's like, it's actually, no, it didn't. The value of your money just went way down, and as measured in your house, that's why you're seeing these house values going so high.
Exactly. So on that, right, it's kind of leading to confirmation bias, because now we've just seen prices go up. We haven't had a major correction in this country since 1996. So 1989 to 1996 was the last major correction. So in 1997, Hong Kong got handed back to the Chinese communist, country. And that started the flood of real estate purchases in the lower mainland. And then that since spread to the rest of mainland China, started to buy up as well. So that was one of the contributing factors in the lower mainland. Now it's an absolute gong show out there, right? Rents are, $3,800 for a 2-bedroom. Your average house, I don't know, is probably $1.5 million or more. It's just become a complete catastrophe, and one of the most expensive, if not the most expensive city on the planet in which to live. So that's the fallout of 20 years of this. So on today, looking at what has led to this massive, comeback in the last few months. Well, it's low inventory. First of all, there's not a lot out there. There was a lot of buyers that were sitting on the sidelines, investors, speculators, flippers, that were waiting for the right time in the market to jump back in. And they saw that pause in the rate hike cycle as their opportunity. And I think they saw the prices correct, 10, 20%. They knew they were going to go back up again, and they said, now's the time. We need to jump in now. But I'm not so sure looking forward. I mean, there was a lot of factors leading today, but I think low inventory is still the main driver. But it would be impossible to predict housing prices 12 months out from now. I think it would be very difficult.
Yeah. To add to that, so low inventory for sure. Canada specific, which is the same as low inventory, is the demand. When we look at just immigration numbers, just the number of people wanting and needing places to live. So there's a huge imbalance there. The other factor was when you look at the stats around the amount of refinancing that happened in the COVID lows, right? Like in the 2020, 2021, when you were getting just dirt cheap interest rates, like definitely lower than 2%. I've heard stories of people under 1%, right? Like a 0.9% refinance. So everyone capitalized on these huge expansion of their assets, refinanced. This is more of a North American stat, but there is like billions of dollars that got accessed through that refinance. So you have all of this cash, you have no inventory. So it's like, I can see why there was the surge, but you're right. Predicting forward, for anyone that's living off of HELOCs or using their HELOCs, or maybe they leverage their HELOC to buy another property. And all of a sudden, if that's an unsecured HELOC, that is definitely double digits, right? Like it's probably at 13% right now. And it's like those payments get tough to make pretty fast.
Yeah, I mean, and when I started as an investor, the main market indicator we looked at was housing affordability, right? We were buying single family. The RBC had a quarterly housing affordability, report that they put out. It was very comprehensive. It was all across Canada, and you could trend that line. You could go back to like 1950, and housing prices always, for the longest time, there was blips here and there, but it was around 30 to 40% of household income went to housing. And how the housing prices adjusted around that, basically until 2020, where it's just completely become unhinged. That number is now somewhere like 70% affordability. It's not affordable pretty much anywhere. And on top of that, surveys that they've done recently, if you follow Nanos or Ipsos or any of these polls, it's something like 7 to 9 out of 10 Canadians cannot afford a house and believe they never will. So you throw those stats in there, and that's absolutely staggering. And you wonder, who is buying up these properties right now, and for what reason? and will pricing ever go back to that 30 to 40% of income? Well, one of two things have to happen, either a downright collapse in interest rates or a massive drop in prices, or both, for that will happen again.
Yeah, I was trying to look up the latest RBC affordability, but I can picture that chart. And yeah, Saskatoon levels, which what I follow, was always, fairly constant.
Yeah.
I mean, on that affordability piece, with these increased interest rates, us in the multifamily game, that's just locking more people out of being able to purchase. Right. And Rosalie and I just went through this on our personal house. We were pre-qualified about a year ago because we've been looking for quite a while. And what we were pre-qualified for 1 year ago to today is dramatically different. And our incomes went up. Right. But we qualified for way less 1 year later. So you're going to have all these buyers that were maybe marginal or on the fringe of what they could afford. Interest rates keep going. They're going to be renters. And honestly, in a lot of cities, if this was only a financial decision on a spreadsheet, all emotions are taken out of it. In a lot of cities, it makes more sense to rent.
Oh, absolutely. I mean, I go by the buy rent ratio, right? Like, I mean, in my place, it's $2,500 rent, $30,000 a year. If it's an $800,000 townhouse, that's 15 or 18, 20 times the rent. So, if you're between 15 or less, then it makes sense to buy. But if you're above that, it makes more sense to rent. I mean, if my all-in costs here are $2,500, but I buy the same unit and it's $4,500 or $5,000 a month, plus I got to shell a $250,000 for a down payment. What am I going to do? I'm going to stay renting in a lot of centers. But you touched on a lot of good points there, but focusing in on the renters now. So the fact that there's going to be more renters, which is great for multifamily owners, which is ultimately where we're going here. Rent control. This is one that has dominated the headlines too. I mean, Ontario, BC, rent control. This has been an abysmal disaster of biblical proportions in rents spiking, 40%, 50% year over year in some of these centers. That hardly sounds like rent control to me. Vancouver now, it's $3,800, $3,900 for a two. It's $2,000 for a one bedroom pretty much across Canada, except in the markets that we're at now. And now these renters, almost impossible for them now to become homeowners. So they're kind of stuck between a rock and a hard place, between relentless rents and high prices.
Yeah, I'm trying to leave politics out of it, but you just can't. So I'm not gonna pick a side or whatever, but when you look at it, that is such a political move, right? Because when you look at politicians, they need to get re-voted in, and that sounds really good. If I'm someone that is struggling and I'm paying rent and affordability is a big issue, and someone says the word rent control, I'm probably voting for them. But we've seen that in those markets, like in Ontario, when you run it out over decades. Like if I'm a developer and I'm planning on building this multi-hundred unit apartment building, but the government says this is all you can charge for rent and interest rates are where they are, and I run my numbers and it doesn't work anymore, so I'm just not going to build it. So now there's less rental stock.
I think this is going to be the defining issue of the next election. I mean, they brought in over 1 million new Canadians last year. There's going to be 500,000 plus new Canadians this year. Where are you going to put all these people? Where are they going to go? I mean, they're obviously going to go to the lesser expensive markets. That's why we invest in those markets. But there's a premiers meeting in July, and I think this is going to dominate. I saw some headlines, and basically, the premiers are going to sit together and talk about a national rent strategy. And it sounds like they're looking for some kind of national rent control. And if they don't impose one, the federal government will. They could call it, I heard it called something like the National Housing Equity Act, where they could essentially mandate rent control across the country. Now that's an extreme, and that would create a scarcity of biblical proportions, especially in the rental market. But, like you say, you cannot keep politics out of this because it is so impacted in these decisions that they've made over the years for short-term gain has now led to where we are today.
I know. I mean, that's one of those things that we obviously we're speculating. We have no idea where that'll go, and you just have to adjust as new information comes available. At the end of the day, what you and I are doing, and we can take the Stony Plain building, so for rough numbers, we're going to take out, say it's $1 million mortgage on that. And from what we're seeing going on in the Alberta market and what we've just talked about, we're seeing rents starting to tick up, right? And we've modeled like very comfortably, we're seeing 200 on like a renovation turn. And then we start adding inflationary pressure on that. There's probably another 200 more, over the following year or so. And then I look at inflationary debt destruction, like on the owner side of the table. So we borrow $1 million today. I don't know what inflation rates are going to be moving forward. So they're 4 right now, and maybe they get down to 2, doesn't matter. By the time we actually pay that $1 million back, that number has been, eroded away. Basically, that's what inflation is. So when we pay that $1 million back, we're paying it back with money that is worth quite a bit less, right? And those are kind of I look at it as a real estate investor. I'm just trying to put myself in that path and let these forces just carry me along.
So yeah, I agree. I think we're getting $200 increase this year. Just met with my property manager in Saskatoon. We're increasing to $1,200. We were at $1,000 last year. So there's another 200 with inflationary. So there's $400 upside available, folks, in the next 18 to 24 months. And I'm going to talk about that near the end and what that means for you as an investor if you choose to invest with us in one of our multifamily deals. But let's kind of segue into investors. So we talked a lot about homeowners and the market in the past, but existing investors in real estate, they're susceptible to a couple things. You mentioned it, the HELOCs. If they're carrying HELOCs, those are variable. And those are getting high. You're carrying a lot of those. If you have 3 or 4 singles, you're probably feeling the pain at this point. You're also susceptible to the valuation fluctuations because your comparables are residential. It's not, investors found that out from 2022 to 2023. Yeah, your house or townhouse can drop 20 to 30%, and it did. Now it's gained back some of that, but it's still not back to the high it was, in February of 2022. So where we go forward from here, we're not sure, but we know that the valuation is not tied to income. So this is why, Mike and I are strongly in favor of multifamily. We love these markets where there's a lot of upside potential, and the fact that our valuations are tied to income. And those incomes are headed up very quickly.
Yeah, I agree. It's interesting. Like, on the residential side, if my neighbor next door sells his house fire sale because they're in financial problems, well, that just affected my house right here.
Yeah, and I firmly believe, because in these really expensive markets, Ontario and BC, 40-50% rent increase year over year. A 25% increase year over year, which would actually be a slowdown, will bring the rent to $2,500 for a 1-bedroom. I think if we're having this conversation 12 months from now or towards the end of 24, I have no doubt it's going to be there. I can see no scenario in this country where rents will go down. None. From where I'm sitting, I don't. And if that is the case, if 1-bedroom rents across Canada are averaging $2,500, the markets that you and I are in, we're now at $1,200 for a 2. Okay. That is now just starting to get back to where we were in 2014. A decade ago. So that's how far behind we were, because of the rental market and the economy, the way it was back then. Alberta and Saskatchewan are super strong economies right now. Like, there's less than 1% vacancy in Saskatoon. Rents, Saskatoon are about $1,200. They're a little higher in Alberta. We just got $1,250. I think we're going to be targeting around $1,300 in the next 12 months, Mike, I think. So I really think there's really strong upside. Even if we end up getting to, $1,800 for a 1, which is insane, we're still going to be lower than most other places in the country.
Yeah, when you say 2,500 for a 1, that blows my mind. Like, that truly does.
It's appalling. It is. There's no other word to describe that except appalling. And saying that as a landlord in some of these areas, Ontario, they use these cash for keys in different scenarios for multifamily owners. They've done very well. You know, they can turn a unit that was paying $500 rent and get $2,500. You know, when you do that on a building, and they can make massive equity gains that we can't on the prairies, but they're taking advantage of that market out there, right?
Yeah, it'll be interesting. I mean, it's fun to kick this around. It's fun recording it and saving it, because now we're going to look back in 6 months and be like, because I mean, at the end of the day, no one truly knows. That is honestly, when you opened this talking about various, you know, pundits or mortgage brokers or realtors or whoever it was saying definitively something. Anytime that happens, I cringe, because it's like, no one knows, right? Like, if we go back to COVID and we listen to what they said was going to happen and what central banks were going to do in 2020, they said, we will not raise rates till 2023 or 2024, right? Like, and everyone just,
and they also predicted the housing market was going to go down by 20%. CMHC predicted.
yeah. And then February hits and rates start going. There's not a single person that predicted rates going and increasing like they did. And if someone's telling you they predicted that, they're lying, right? Like, so that's why, like, taking a definitive stance is pretty dangerous. I like the idea of sort of game theory, like, what are the various probabilities? How do we protect our risk? You know, and where we're investing in the prairies, I'm feeling pretty confident, right? Like, we're seeing our income going up. Obviously, we're in the same boat as everyone on interest rates, you know, but vastly different purchase price.
So a couple of things we're going to wrap up with here. We'll talk about the benefits of multifamily and how it's changed. We talked about this on our webinar a couple of weeks ago, but let's say we get that $400 increase, which I'm fully planning to do. That equates, if you figure that out on a cap rate basis, that's about $80,000 in value per unit, right? So if you have a 20 or 30 or 40 suite building, there is a ton of equity up for grabs in the next 24 months. And I think this is inevitable. Unless you're in areas that are really bad, you have a lot of maintenance deficits, or you buy something that needs a lot of work or very tough to manage. If you do this smart, or you invest with us, I think this is almost inevitable. The other thing that's changed is Mike and I are going 5-year buy and hold immediately. We're going to CMHC right out of the gate. We are not doing the BRRRR strategy anymore. We're not doing the bridge loans. Because now, what's a bridge loan going to be at now, especially after yesterday? 12% plus a 2%.
I think we have to each ship a kidney in. 2 left kidneys gets you a bridge loan.
Yeah. So if I hear the word BRRRR or the term BRRRR now going forward, I just shudder, because it's like, unless you're buying that apartment building at $50,000 a door, that strategy, to get your rents up quick, refinance, get all your equity out in a year, is very, very, very tough to do. There could be some creative financing in there. There's going to be a lot of apartment building owners. And we're seeing that now. There's a ton of buildings for sale. People are trying to unload their junk. We're realizing now, okay, well, investors are going to demand 6 cap because we're borrowing at 5.
Yeah.
And guess what? Your building needs $500,000 in work. So
what? And we have to realize, like, we're so early, because the average term is 5 years.
Yeah.
Right. So that means there's a whole bunch of owners that haven't had to cross this hurdle yet. Like, they're still locked in at their, 2% or their 2.5% or their 3%. Like, I have a building, I have a 12-plex that comes due mid 2024. This is a non-CMHC mortgage, so I think we're low 3s. I know that's resetting into the 6s probably. Maybe if we have, like, if I don't go CMHC, right, I could go CMHC, and knock a little bit off of that, right? But I'm already planning. And luckily we have a really low loan to value. So we have a lot of cushion there. But if you were in a situation where if you're 90% loan to value, 85% loan to value, and all of a sudden your interest rate when you renew is double, what does that do to your payment? What does that do to your debt service ratio? And basically the bank is going to be telling you, cut me a big check to renew your mortgage.
Yeah, it's yesterday's a wake-up call for everything you just said, because CMHC rates today are more than they were a year ago when people opted into MLI Select. So, you go 4 years out, unless rates have dropped or you've increased your rent substantially, you're going to have to pay the bank back.
Yeah.
And most likely, depending on where you are, I think the rent increases are going to offset that. I think most people won't be in a negative equity position, but a lot of people will be for sure.
Yeah. Yeah. And that's the good news. Like you said, the 400, or whatever the number is, when you extrapolate that, that income is going to be a lot stronger to service. So it'll be interesting to see how it shakes out.
And politics aside, so, like Daniel Smith or Hayter, the Conservatives are in power for the next 4 years in Alberta. They're not going anywhere in Saskatchewan, probably Manitoba either. So, we can look for some showdowns with the feds, but we can look for a very strong economy. We can look for, very stable rent increases going forward, I think. There's possibility of a recession, but I do not believe we're going to be in that position in 2015 where we're going to have to drop rents in Alberta again anytime soon. With what's going on in the rest of the country, I just don't see that as a possibility at this point.
No,
right?
I agree. I'm excited.
A lot would have to happen.
Yeah.
Hey, good. I think we've pretty much chewed up our time. I didn't want to do a long video today, but so there's our take on interest rates and basically why you should get into multifamily. 80,000 a unit on a $400 rent increase. Get in on multifamily. Get in today. It's very much likely that next year prices could spike up to the 120, 150, 180, or 200,000 a door range. That's not impossible on the prairies. I mean, we saw that happen in New Brunswick like 2 years ago. People said that would never ever happen in the Maritimes, and there they are. They implemented rent control. Multifamily product just went insane, and that was a lot of speculation from Ontario, which is now pushing west. So you want to get in on multifamily assets. You want to get in on them now. So contact Mike or myself to learn how you can get in on our latest deals. We're going to be launching a limited partnership soon. We're super stoked to have some more deals in the pipeline, and especially excited for the next year and a half.
Yeah, it'll be fun.
And maybe hopefully a change in federal government, but we can just cross our fingers on that. Okay, cool, man. Well, thank you again, everybody, and we'll see you in the next video.